Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Alrighty, we're ready to get started today. How is everybody doing out there? Hope you are doing well. Happy Wednesday. Hope you are having a great start to your day. My name is Andrew Kuhn. Of course, as always, sitting across my co-founder, Mr. Geoff Gannon. Geoff, how's it going over there?
It's going great, Andrew. How's it going with you?
It is going great. Of course, we hope it's going great for everybody else as well. But if you do want to get access to Geoff's weekly memo that he does send out on the weekend, on Sunday morning, go to focuscompounding.com, and on the homepage, you will see a place to enter in your email. Mm-hmm. And that will allow that to be entered in, and you will receive an email from Geoff every single week. Also, we talked about this last week, and it is pretty important to us. If you guys like the work that Geoff and I are doing, obviously this is for free. You want to help us out, you can go onto your podcast app on iTunes and give us a rating and review. Mm-hmm. And we will be greatly appreciative of that, right? Helps keep the lights on.
Yeah.
Actually, probably not, because we don't make money from this.
We don't make money from the podcast, but it'll help other people find the podcast.
Yes, and that's how iTunes works. So today we're going to be continuing our SuperInvestor series. Mm-hmm. And it's actually one of the most listened to podcasts that we've done was the one that we did on Warren Buffett.
Okay.
And today we're going to be talking about Joel Greenblatt. Mm-hmm. Would you consider him a SuperInvestor?
Yes.
Okay. Yeah, I would too. And for those who don't know, and I'm sure you do know because we've talked about him a lot, he is the author of Geoff and I's, or my favorite book, You Can Be a Stock Market Genius. Yep. And I guess our investment strategy, part of that, the spinoff sort of stems around, I guess, his philosophy that he writes about in this book and, things that he teaches. But he's a Columbia Business School professor where he teaches the special situations class. So spinoffs, merger arbitrage, probably all things that he wrote about in the book. And he was a hedge fund manager in his past life, Gotham Funds. Yeah. And I think that's obviously what his sort of claim to fame is. He started Gotham Funds in 1985, and he ran it for outside investors for 10 years. Okay. I think the total lifespan of the fund was 20 years. All right. But he ran it for 10 years, and during that period, he achieved compound annual returns before fees but after expenses of 50%. Mm-hmm. So he started with $7 million, which was mostly raised through junk bond king Michael Milken, and then after 5 years, he returned half the capital, and then after 10 years, he returned, I think, more of the remaining capital, and then kept.
They closed it to outside investors.
Yeah, he closed it and just managed his and his partner's capital.
Yeah, and the annual record, there's in the book.
Yep,
at the back of the book, I think.
Yep. And he also has written 2 other books as well. Mm-hmm. So he has You Can Be a Stock Market Genius.
Right. That's my favorite.
Yes, that's our favorite. Right. The Little Book That Beats the Market.
Which is fine, yeah.
What's the other one? The Big Secret for the Small Investor.
Okay.
Did I get that one right?
Maybe.
Which I think he says is, it is. I'm looking at it right now. The Big Secret for the Small Investor, which he says is still a big secret because nobody bought the book.
Yeah. I've read all 3 books.
And then, and then The Little Book That Still Beats the Market.
Okay.
And today he runs also a mutual fund, I think, where he employs the little book that beats the markets type of strategy. So high return on capital with high earnings yield, you put them together and you get, potentially good longs, and then you could flip it on the other side and get good companies as short as well. Right. So
maybe we should go over each of the 3 kind of strategies, because they're not just different books. They're actually different kinds of ideas that he talks about in each of them.
Yeah, absolutely.
Right. So You Can Be a Stock Market Genius is special situations. Right, so things like spinoffs, reorganizations, mergers, leveraged recapitalizations, things like that. Then, like you said, the Little Book That Beats the Market is a combination of high return on capital and low EV to EBIT multiple, right? Mm-hmm. Yeah. And the last one is valuating the indexes.
Yes.
Yeah. Mm-hmm. Instead of price weighting them.
Yeah. And what's interesting, why do you think I guess he sort of talked about it in the class notes that I've tweeted out before, the audited class notes, how they switch strategies because they would wake up and their net worth would change by like 2 to 3% per day because their portfolio was structured like 5 to 6 securities, right?
Yeah.
Or 5 to 8. It was very concentrated. Yeah. And I think he actually, in the book, he did a study or he referenced a study that showed if you own more than 8 stocks or own more than 10 stocks, you actually, when it comes to business risk, are not any more diversified than if you own, way less.
So you are slightly more diversified, but what it is that some incredible number, I don't know if it'll be half or something of the diversification that you can achieve in terms of just picking different stocks. So not market risk, but business risk. You'll achieve that in like 3 stocks, right? And then if you think about it, to get the next 10% of diversification, if you imagine the possibility they could be 100% diversified, right? So like 100% diversified would be you own all, let's say in this case, you own all of the S&P 500 or something like that. Well, you get pretty close to that when you own, say, 20, right? And so a lot of value investors even will say that it doesn't make sense to go beyond 30 or so stocks. And I think that's definitely true. And yeah, he concentrates, they talk about, I think, 6 to 8 or something like that is the number that he gives in there. I don't know if his fund was even more concentrated than that. Sometimes it sounds like it might have been more concentrated than that, or that they weren't evenly weighted. But when he talks about it for suggesting what you should do at home using the book, he mentions 6 to 8 as being enough diversification. And I think that's probably right. Now, there are other kinds of diversification that you can get by owning different kinds of stocks and things like that. So like one of the ways he probably wasn't diversified is if he was doing spin-offs and recapitalizations and things like that, he was probably more exposed to credit risk, right? Because there wouldn't be very many stocks with good balance sheets in there. So that could have been a problem. But he was in a time where that wasn't a big issue those 10 years. But if it had been 2008, that might have been a big issue.
Sure. Do you think a lot of, I guess, your performance could come obviously on, I guess, timing of when you started, when he started investing, stuff like that? I'm looking in
that's the perfect 10 years.
Yeah, sure.
Right. I mean, maybe you could have gone one more year or something like that, and it still would have been perfect. But from the middle of the 1980s to the middle of the 1990s is pretty perfect for stocks, yeah.
I'm looking, and it says for those 20 years, $1,000 would now be $836,683.
Okay.
That's pretty crazy, isn't it?
No, they're amazing returns, 50% annual returns. But like when Buffett had his partnership that he ran for, I guess, 13 years or something around that time, his returns before his fees were about 30%. But you have to remember that the market's returns were in the single digits. So it was a harder time. So like Buffett's record is in a time that was more difficult, but Peter Lynch was in a time that was easier for his decade or so, and Joel Greenblatt was in a time that was easier for his decade. I don't know how good the returns were over the 20 years or so.
Why do you think he switched gears with his strategy for like managing outside capital?
Well, one, I think it became more difficult to invest in these kinds of things. I don't think spinoffs will do as well now as they did then. And maybe writing the book and stuff had some effect on that, but I don't know if that's really the reason. And then I also think the issue of scaling up. I think some of the best returns that you get in these kinds of things are in smaller stuff.
Yeah.
Even when we talk about spinoffs and things with the managed accounts that we do, and even in some of the case studies he gives, like he gives a case study that's Stratic. That's a really small stock when it was spun off from Briggs & Stratton, and that's a good example of the kind of thing.
Do you remember the market cap of it?
It might have been $100 million.
Because I'm looking, when he finished, or when he returned all outside capital, it says that he finished with more than $350 million in return all of the capital.
Right, so that's not a huge number compared to some value investors, and it's particularly not a huge number for someone who was getting those kinds of returns. You could have raised a lot more by that time. And obviously Ben Graham very severely limited how much capital he managed. What he would do basically is pay out the profits as consistently as he could each year. He basically tried to keep the fund the same size as much as possible, and that allowed him to do some of these things that are really low risk. Right, so Ben Graham did things that were almost arbitrage type stuff that he was able to do, and it was possible, and nets and things like that with really small amounts of money. There are big spinoffs, but I think some of the good spinoffs, some things like that, are when you have a really big company spinning off something really small. I'm not sure that they're when you break up a company in two that they are as attractive.
Sure.
Yeah.
And he was the one. It's kind of a unique story because obviously he started Value Investors Club, right? Or he was a part of the group or whatever that started Value Investors Club, and I think he's talked about it publicly before. The reason that they started it was because back in the day, before how the internet is now, there was people that used to write about stocks on Yahoo message board.
Right.
Did you ever do that? Because you were sort of the first one. No.
No.
Yeah, and that's how we found Mike Burry. And he said, "Well, wow, I guess there's other smart people out there." And he like reached out to him and seeded him with capital. And you've obviously seen The Big Short, right?
Yeah.
Was Joel the one that was portrayed in that movie where he was like, "Give me my money back" or whatever?
He was, yeah.
Yeah, and he was like, "You're a stock picker. What are you doing with these CDSs and whatever?"
Yeah, I don't know how accurate the
of course, it's probably glamorized,
how much
right?
They dispute it and stuff. I don't know, like, and Bill Miller's in that one too, right?
Yeah.
And I don't know if Joel Greenblatt and Bill Miller feel that they were accurately portrayed. I don't know.
He's like, "Get me my F and my," or something like that.
Probably. Yeah.
No, that's hilarious. So then today, and I guess so we could talk about the little book that beats the market. So you said you think that he sort of switched gears to that probably because just the strategy was he said that, like I said before, that their net worths used to deviate between like being up and down like 3% to 5% one day. Now it's probably like more like 30 basis points.
Right. That might be the reason for it. The other possible reason is if you're writing for people, and he was already had written, You Can Be a Stock Market Genius, you realize that sometimes the things you'd suggest to other people are different than what you might follow yourself. And that's certainly true for me talking on this podcast and stuff. I might be comfortable owning 3 stocks that I picked myself, but I'm not going to suggest that for other people. For one thing, I'm comfortable not buying anything for a year or two or something for myself, and I think most people wouldn't just sit there and do nothing, right? So you say you sort of change the advice a little bit and suggest different things that you think are practical for people to carry out themselves. That's what happened with Ben Graham. He really wanted to focus on not getting the highest possible returns he could get, but coming up with systems that anyone could implement. And I think that's some of what you're seeing with the little book that beats the market. Because if you read You Can Be a Stock Market Genius, I'm not sure that's that easy to implement. I mean, we use it as a guide to what we do, but it doesn't really tell you what to do. It just tells you where you can sort of look at things and kind of gives you case studies that sort of show you the kind of thing you're looking for by example, but they don't have any sort of formula at all or anything like that. And it's not the sort of thing that an academic would... I mean, academics have studied spin-offs, but for the most part, this isn't even something that they would look for the returns in and stuff, because they'd say, okay, well, how exactly do you do this? Which ones do you pick that you don't invest in? Which do you pick that you do? Are we investing in all of them? And that's kind of what they've done. They've looked at like, okay, say you bought every spin-off. It's not really what the book says to do.
Sure.
Right? It's not what we do. I don't think it's what really anyone does. But that's the only thing that they would write a paper about.
Yeah, sure.
So the little book that beats the market is something that you can study and test and all that, and they back tested it, and and I would say that although we love You Can Be a Stock Market Genius, when the little book that beats the market came out, everything, it had a way bigger effect, not just on value investors, but just generally in the internet and people's awareness of it, and the idea that it's a strategy that people know what it is. It's like Dogs of the Dow or something. It has a name and people know what it is, and it gets talked about in a way that I think You Can Be a Stock Market Genius, which is the better book, doesn't get talked about.
Do you think it's because it's pretty simple and he has the website up, and I think his instructions are literally go pick like 30 stocks per year or whatever it is?
Yes, and there's a back test.
Yeah.
And I think the combination of here's a strategy and it worked in the past is what gets people excited.
It's pretty interesting too that he's talked about if you actually go through and kind of cherry pick the ideas, that it doesn't actually add or it doesn't add to like the performance and whatnot.
Yeah, it's interesting. I think that's maybe true. I don't know that I'm not a big fan of the little book that beats the market in terms of a strategy, the magic formula. I don't like it as a strategy. Because basically what it is doing is it's saying, taking the Warren Buffett approach, but you can't actually tell what has a moat and what doesn't. So buy them all. Basically buy a basket of them. So it's like invest in the kind of stuff Warren Buffett does, but don't have his approach of trying to figure out which things are durable and which aren't. And he's probably right in that like cherry picking them doesn't get you better returns. That's possible, but I think you could cherry pick them to reduce risk.
Do you think it's a good place for people to start to look for ideas, almost use as a screener?
I don't really like it as a screener. I've looked at it many, many times as a screener, and I generally don't like it. For a few reasons. One, people tend to run the screen that has the biggest stocks, which I think are the worst.
Sure, yeah.
To do that way. This is the same thing as the net nets. People always talk about the biggest net nets, and the biggest net nets are always, or not always, but usually the worst net nets.
Sure.
The best net nets are usually the small ones. But what gets written up and what I see, you never read magazine articles and things about little net nets. You read them about the few times that you have really big net nets. But then that means that someone's going to write about like Circuit City or something. You know what I mean? It's going to be something that is really hated. The magic formula works that same way, where there's some of the most controversial sorts of things. That tends to be what's on. They're sort of busted growth stocks is what shows up on that list usually. Not exclusively, but yeah, I would say so. They're more contrarian type things.
What was in the book? Because I didn't read The Big Secret for the Small Investor. Do you remember what was in that book?
I don't remember except just what I said about valuating instead of yeah.
That's interesting. Yeah, and I know I've said it. Have you read those class notes that I've tweeted out before?
Yeah.
And I think that's a great source for people to learn.
Yeah, that's terrific. Absolutely. Yeah.
I wonder how much of his current class is a lot like, because those notes are from like the early 2000s.
Mm-hmm.
And I wonder.
But those are great notes. Yeah, and Value Investors Club the same way, where it's sort of you can see what write-ups are good and what ones aren't. And actually, I think he used an example of in the notes, right, about a write-up from Value Investors Club.
Yeah. Mm-hmm.
Yeah. So I think they're excellent from like how to appraise something, and a lot of the. Those are great to look at that, because it really is looking at a company and coming up with a valuation for it.
Mm-hmm, sure. Yeah. Do you use Value Investors Club?
When we talk about a stock or something, I look to see if it's talked about there.
Yeah.
I can't say that I've ever got an idea from Value Investors Club.
I think it's good to, what I use it for is if we start looking at a new company, just to kind of go get like some background on it, see what people have said about it in the past, because that could obviously be pretty beneficial.
Yeah, there's a variety of people in Value Investors Club. I'd say a lot of them are, they tend to be professionals, and a lot of them are more short-term oriented with a catalyst kind of thing. They're much more focused on how quickly an idea will be successful or not. Mm-hmm. And there's a surprising amount of people writing about short things, and they're often they're not that great. The write-ups might be wonderful, but the performance is poor.
Yeah. Sure.
So.
No, that's pretty interesting. What's funny is he discovered Benjamin Graham, I think when he was in college. He's talked about how he had to do some sort of like academic paper or something along those lines, and he came across Benjamin Graham. To you, do you think he's more of like a Warren Buffett or more like a Graham? Maybe back in the day he sort of shifted gears a little bit, because if you look at a lot of you could be a stock market genius. It's not like all those companies were like not leveraged businesses and had clean balance sheets and were companies that Warren Buffett would like to buy. Right.
Although Buffett wasn't necessarily the same kind of investor when he was running the partnership.
Sure, it's true.
And some of these things, if you read the case studies and stuff, were incredibly cheap. So it is true that he bought into situations that used a lot of leverage and stuff, but you can be a stock market genius talks about things that are really value type investing things. When we're looking at spinoffs today, that's much less true. There are things that are spinning off from companies that are pretty expensive and pretty successful. You see it much more often now, where they're not really troubled, cheap sort of companies spinning things off that are really cheap. So I think that probably, though, he did... I've heard him talk a little bit about these things, but I would say that he may have learned while he was running the fund that some businesses that were really good businesses maybe worked out longer, than he would have expected. That the idea kept doing well. He talks a little bit. Does he talk about Moody's in there? So Moody's was
he talks about Moody's, I think, in the class notes.
Class notes, okay, yeah. Because I was wondering
that I tweet out. It's my pinned tweet if anyone wants to check that out.
Okay.
At Focused Compound.
At Focused Compound. So because Moody's, he would have been investing in something that Buffett was also investing in. Buffett bought Moody's on the spinoff.
Mm-hmm.
Yeah,
sure.
So Moody's was spun off from Dun & Bradstreet, I think.
Got it. I'm looking at. He's a great author too, by the way. Like, he's pretty funny.
Yeah.
In his writings, like, he's very witty, very very funny, very entertaining. So I guess what I liked about his, because the book goes over, you could be a stock market genius, goes over spinoffs, mergers, bankruptcies, restructurings, rights offerings, risk arbitrage, merger securities, and recapitalizations.
Yeah, and if I remember right, the risk arbitrage one isn't even a profitable story. It's a story about how everything that went wrong. That's the sinkhole story, I think.
Yeah. Uh-huh. And so how he concludes every chapter is he gives a little quick summary. So I'm going to read off what he says about spinoffs. Maybe you could add some commentary on what you think. Number 1, spinoffs in general beat the market. Obviously, we tend
historically they have, certainly.
Yeah, we tend to, and
I would caution total spinoffs of U.S. stocks.
Yes.
I read a lot on other blogs about these partial spinoffs of sort of things in Europe and stuff, and they could be doing that for very different reasons. So U.S. companies completely spinning off something, they outperform.
And he also references a Penn State study that showed that they outperformed by like 10% per year or something like that.
I think that's definitely declined.
But that was in like that was a while ago. But Monish Pabrai, he also did one recently and he ran a study and they still outperformed, but it wasn't as good as it was when he ran or when the Penn State study was referenced.
But I mean, I don't know that I've seen like any academic studies of any metrics that outperform by 10% a year, right? Even when we talk about things like some of the things that perform best are like small like micro cap value or something, right? Well, that doesn't outperform the market by 10% a year.
Yeah.
Right.
Sure.
Yeah.
Alrighty. Next one. Picking your spots within the spinoff universe can result in even better results than the average spinoff.
I guess it's true.
So, I mean, that does make sense, right?
Yeah. I mean, I like spinoffs that are good businesses.
Yes.
Right. So that's the thing that we focus on more. And I have bought into some spinoffs.
The way that we sort of look at it, I would say, is it's really just, and I sort of wrote about this in the last letter, is just fishing where the fish are, right? In the right pond. It's just a pond that historically has done very well. And if you could sort of cherry pick the great businesses from there, we think obviously you can do okay.
Yeah. One thing I should point out is I've probably bought the remaining company more often than I've bought the spinoff company.
Really?
Yeah.
That's interesting.
Yeah, I believe BWX Technologies was the remaining company of Babcock & Wilcox, even though the name Babcock & Wilcox went with the other one.
Because in his examples, he kind of always buys usually the spinoffs, right? They're the ones that are left for dead. They get...
But think about NACO, for instance.
Yeah.
The NACO was the remaining part of the company, but the spinoff, when it spun off, certainly, even just by market cap, but definitely by enterprise value, was valued much higher than the remaining part of the company. So they spun off something that ended up being worth by the market's how the market estimated its value on day one, more than 50% of their company. Right?
Sure. Yeah, that's interesting. Yeah. Alrighty. Certain characteristics point to an exceptional spinoff opportunity. Okay. And then he lists some. Institutions don't want the spinoff, and not because of the investment merits. Okay. So what does he mean by that?
Things like it will no longer be in an index.
Yep. So you get some index selling.
Too small.
Yeah.
Right. So if the company was $1 billion and now it's a small part of that.
Not even just institutions, but also individual investors as well, right? If you think about, like, for example, KLXI, right, which we've publicly talked about, Boeing is purchasing them and they had to spin off. Right.
They just did spin off KLXE.
Yeah. So if you think about people that own this aerospace business and now they own this little energy services, E&P business, right? That could create some sort of selling pressure.
And the spinoff is probably, I would say, about 15% of the total value, right? And then these are people who want an aerospace business, and they're getting cash. So they're forcibly being cashed out of 85% of their position. Are they going to hold on to the other 15%? We'll see. It's just spun off, but it'll take a little time.
But I think that's a good example to sort of demonstrate it.
We also talked about Hamilton Beach Brands, which they spun off. Another way that this can happen is they chose to spin off both A and B shares to you regardless of whether you owned A or B. And that was confusing to some people, and some people didn't want the B shares. So,
do you think, and from your history, do you think spinoffs where you have two completely different businesses in different industries, do you think that's where there's potentially the most opportunity?
Yeah.
Yeah, I would
agree. And I think spinoffs where the spinoff is so I think spinoffs where there's a size difference between the companies are also a big part of it. So not something, I don't think seeing a $6 billion company spin off into two $3 billion companies is going to do that much for you.
Sure.
But seeing $1 billion company spin off something that's $100 million might,
Next one, insiders want the spinoff.
Yes,
obviously.
And KLXE is a good example of that. They chose not to take any. First of all, if you read the background to the deal, they basically decided not to do a deal where they sold themselves entirely to Boeing because Boeing was willing to do that, and chose to instead have the spinoff happen. So that was their. They felt they weren't getting a good enough price, and then they chose not to take salaries and instead take a percentage of the company. So they get paid with the percentage of the company over like 3 years. So
so their incentives obviously are on the same side as shareholders.
Yeah.
Exactly. Okay. A previously hidden investment opportunity is uncovered by the spin-off transaction. An example, a cheap stock, a great business, a leveraged risk-reward.
Yeah, that's definitely true. That's the biggest part of it.
Yeah.
Is that last one that you said. Because like BWX Technologies is a great example. It was, Babcock & Wilcox was 3 pieces to the business. It had one money-losing part of the business. It had one highly cyclical part of the business, and then it had a very profitable and incredibly non-cyclical business. And that's the one the market valued almost 3 times as much once the other parts were taken out. Yeah.
Alrighty. Next one. You can locate and analyze spinoff prospects by reading the business press and following up with the SEC filings.
Yes, it's
Obviously,
easier now. It's much easier now than
when he wrote about it. He just said, check the Wall Street Journal pretty much.
And read Edgar.
Yeah. Nowadays, there's good blogs about it. We've talked about Clark Street Value. We blog about a lot of ideas.
Yeah.
I think Zen Investing. I think that's one I also came across. Or Spinoff Monitor, Spinoff Review. Those are all really good sources.
If you just follow at Focus Compound, you will see spinoffs mentioned.
Yeah.
You'll retweet something that is a spinoff, whatever, even if there's not analysis of it. And Focus Compounding, the site, has write-ups of most all the interesting spinoffs I feel like are being written up there.
Mm-hmm.
Yeah.
You'll like this one because what you said, paying attention to parents can pay off handsomely.
Yes, I agree with that. And here's another reason why. Because when there's a spinoff, so what's happening with a spinoff is it's telling you a few things about the company that are really interesting. One of the most interesting things is it's telling you that they care about shareholder value because they're breaking up the company, and the managers who are staying with the parent, are going to have a smaller fiefdom now, right? So it's going to be, they're not going to be as high up in the rankings of whatever, size of their business they are. It's going to be somewhat harder usually to justify being paid as much or more, because that's often done by size of the company, and when they compare them to peers and things like that, they'll be in a different peer group. And so they're doing it probably for some sort of recognition by the market, right? Mm-hmm. And that's true whether you're the parent or the spinoff. The difference is the spinoff, when a company spins something off, it usually means, with some exceptions, but it usually means they would have liked to have sold it, but they didn't get the bids that they wanted and stuff. So maybe it's a bad time for the company like KLXE. They felt it was a bad time for the industry, oil services, and they didn't get a bid that they thought represented the value of the company.
And if you read the background of the transaction, they actually say that. Yeah.
So basically, they'll just wait till a better part of the cycle to sell the company, if they do sell it. I don't know. That one's actually different because the deal has different IRS treatment, so that one could be sold quickly. Usually, we should say a spinoff. In the U.S., a spinoff is not, I would say there's like zero chance of it being sold within 2 years or so, about that, and maybe longer, because it could trigger tax consequences. So occasionally there are spinoffs that are taxable spinoffs, and then that's not the situation. Mm-hmm. And that's one of them.
Got it. Next one, there's two left. Partial spinoffs and rights offerings create unique investment opportunities.
That might be true. Rights offerings are definitely treated very strangely by investors. So that's definitely a possibility for a serious mispricing. However, rights offerings do often happen with companies that are in serious distress.
Do you want to explain? Because Greenblatt Partners, they had a rights offering with Dan Loeb's firm,
they did,
correct? And
yeah.
David
So a rights offering is when they give. So a rights offering is when existing shareholders are offered the chance to get additional shares in the company. But basically, if everyone subscribes to it, if all the existing shareholders decide to exercise their rights, they'll all just end up putting money into the company and end up with the same proportional interest. But some people will not exercise the right, and that means that your interest can increase. So if you're a 10% shareholder and most other people don't exercise their rights, you'll go up above 10%. If you choose not to exercise your rights and some other people do, then your interest is going to drop below 10%. Mm-hmm. But the reason why a company would do it is because they want capital and they need cash, and they, for some reason, aren't borrowing it. So when I mentioned Babcock and Wilcox, the part that that was not successful in that spinoff, the coal part of it, got into a very distressed situation and eventually did a rights offering. And that's a reason to do it. The rights offering in that case was because they needed capital, and probably there were some things also about like control of the company and things like that, where they wanted to be careful about that. So those two factors of who owned how much of the company and that you need capital are the two things that usually happen in rights offering. So I would say that usually they're weaker balance sheets, and you should really pay attention to rights offering. That's probably something about the situation means they can't raise debt. Yeah.
Got it. And then the last one, which I guess this kind of shows his entertaining self when you're reading it, he says, "Oh yes, keep an eye on the insiders." And he puts in parentheses, "Did I already mention that?" Yeah,
he's big on looking at the insiders. Yeah. And as we mentioned with KLXE, they chose to forego salary in exchange for a meaningful percentage of the company.
Mm-hmm. Yeah. What are your opinion? What's your opinion on leaps? And he talks about that in the book.
I like leaps.
Have you ever used leaps to purchase a stock? Or to, I guess, play a stock or invest in a stock?
I suggested Leap. So here we go. We did podcasts on GameStop and Entercom, right?
Yeah.
Yeah. So the author of those who we had on,
Vetla Forschlad.
Okay. I suggested to him after he wrote those up, I said, I think you should do an article about those stocks with leaps. Because me personally, if I was looking at either of those stocks, I would not buy the stock. I would buy leaps. So we should talk about why that is. And I think he uses the example with Wells Fargo, right? Back in the early 1990s. Is that the one he gives? Okay. Which I also think that Bruce Berkowitz bought the same thing, or bought the stock, I should say. I think he got the idea from Berkowitz to buy Wells Fargo. But so it was a excellent bank that was in trouble because California real estate was in trouble. So the downside risk is big. There's some meaningful chance that it could go to zero, I guess. And yet, if it doesn't, the company's wonderful and so it'll compound at a great rate. That's when you want to use leaps, right? When you think there's a really big upside, but there's some downside you can't get rid of. And that's the risk. The other way of doing that is like we've talked about, I think on this podcast, but if not, we are now, Hostess Brands. Okay, so Hostess Brands has warrants. I don't know how, like warrants are an excellent thing. They're rare in the modern stock market, but warrants are like stock options, but basically they're things that the company will get cash for if they're exercised. And so they're usually created as part of some sort of transaction, in that case, like a leveraged buyout type deal, right? So warrants work the same way as leaps, though. They're basically a way of buying a long-term option on the stock. And the advantage of it is you don't tie up capital, so you get big leverage on it, and that's appealing to some people. But what I'm thinking is that the appealing part is that you can get a lot of upside without taking a big downside risk. So what you can do is, if say you would normally buy a 20% position in your portfolio, with leaps or something, you could buy a 5% position, depending on the price of the leaps versus the price of the stock. And you might get the same sort of upside you would get by just buying the stock outright. And yet your downside is now only 5% of your portfolio, not 20%. Right? Now you could buy the same size position, and then what you're doing is you're just leveraging your portfolio up incredibly, because leaps are options and warrants are options that create incredible amount of leverage. But they're long term, which is the huge difference between them and options. So in the case of GameStop and Intercom, for anyone listening, if you want to look at those things, I would actually suggest looking at the leaps, and they have leaps for those two stocks. So you can go and check out the options. I think leaps expire in January of each year, right?
I think so. Yeah.
Okay. So you would look, and then you would see. So they could be up to 2 years, I think, right? And then depending on the time of the year, they could be anywhere from 2 years to like a year.
Interesting. And I guess we should have probably talked about in the beginning. He is 60 years old. Is that correct? We were kind of laughing about this beforehand because Jeff was looking over my notes that I had for Joel, and I had in here that he's 60 years old, and he's like, "Oh, is that how old he really is?" And I was like, "I don't know. I got it off of Wikipedia."
Yeah, and I said, "Did you check the citation from Wikipedia? Where Wikipedia is citing as their source?"
Yeah, so that I go to Wikipedia and I look at references, and the number 3, Gannon, Jeff, Value Investing Encyclopedia, Joel Greenblatt, December 28th, 2005.
So maybe you shouldn't always trust Wikipedia.
Yeah.
In this case, if you're trusting Wikipedia, you're trusting what I thought his age was in 2005.
Because what you said you estimated it or whatever?
Yeah, I read a couple articles and I estimated based on some sort of facts. I sort of triangulated things to figure out what his age was. So I could be wrong, but Wikipedia thinks I'm right.
That's so funny. You've been on the internet forever. 2005. Yeah. I love it. So do you have any final thoughts on Joel? Or, for me, I think he's just because there's a lot of information out there, his performance has been so great, and because there's a lot of people that have good performance, not as good as his, but they don't really, I guess you could say, like uncover what they did during that time. And I think that's what's always attracted me to his, learning the way he thinks about things. And on YouTube, there's videos that he's had recorded of his actual class, which is a ton of fun if you're investing junkie to go and watch. And of course, like I've talked about, his audited class notes, so he's given back a lot to the value investing community. Right.
And I think the people that you can look for who had great performance, or great risk adjusted performance at least, and talked about it extensively are Ben Graham, Warren Buffett, Peter Lynch, and Joel Greenblatt. Those are the ones that really stand out, that if you want to learn from people who really did for 10 years or more, have an excellent record, it's those people, because they really put down so much detail about what they did. There's lots of other people with great records, but there's much less information from them about why they did what they did. I think maybe we should talk a little bit about why You Can Be a Stock Market Genius is our favorite book, and why we apply those techniques in the managed accounts. Because I mean, when we did a presentation on it, we talked specifically about his book and his ideas and what our ideas were for the managed accounts. Because the managed accounts do not just invest generally in everything, right? They're only it's overlooked stocks. That's the idea. And part of that, and so it's part Ben Graham, you could say, and part Joel Greenblatt.
I think people would fire us if we bought Apple or Wells Fargo or all those other stocks. Yeah.
But so what is it about his approach that made it that's the kind of thing that we wanted to focus on?
Well, for me, I guess, when I read this book a long time ago, it was sort of one of those first books that I was like, wow, this is finally, like, he's sort of adding context to this whole value investing thing, right? When you would read a lot of other people's, books written on stuff, this book and Robert Hagstrom's Warren Buffett Way was kind of the only book that actually, like, talked about, I guess, applying real multiples to businesses and like transactions and stuff like that. So it sort of added context to this value investing theory that I had when I read it a long time ago. But again, I think what has always been so attractive to me is, especially if you're dealing with smaller sums of capital, it's a great strategy to employ. It's a pond, like I said, that historically has done pretty well. Right. And if you can sort of take this, this stock picking sense and go and fish in that pond, I think I always thought it was a pretty good pond to fish in.
Okay. So what are the downsides to this approach?
Downsides are there's not unlimited ideas, I guess you could say, right? Especially with spinoffs.
Well, you're owning a small number of stocks.
Sure. Right? Yeah, it's more concentrated for sure.
Because there's just not going to be enough situations happening at any one time.
More volatile.
Right.
For sure. Yeah.
And then you also have that these are not stocks everyone's talking about. Yeah. So you have to just kind of, if you really focus on this the way that he did with the fund, you're buying things and caring about things a great deal that most people aren't even really looking at that hard.
Sure.
Right? So there's some special situations investors you can find. We talked about Clark Street Value blog is really a special situations one. And there are others like that. You can find special situations investors who that's all they talk about. But outside of that group, even with other value investors, they're going to want to talk about what Warren Buffett owns. They're going to want to talk about the latest cyclical things that are, they could be talking about all those things. And this is, instead, you're talking about things like, let's give some live examples, right, that this still happens. Okay, so we talked about KLXE. That's happened, I think, as we're recording this, that happened yesterday, that it spun off. Okay, there's, ServiceMaster is breaking up. Right. So ServiceMaster is going to split off into one business will basically be Terminex and one business will basically be American Home Shield.
Yeah. The home warranty business.
Yeah. Home warranty business. So that's a pest control business and a home warranty business, and that's happening now. Let's see. Oh, there's also Honeywell is having two different spinoffs that are happening. So it's going to spin off Honeywell Residio, which is Honeywell Home and a distribution business. But basically, that's the original Honeywell. Essentially, they're spinning off their very first business, right, from the 1800s. And so that's like thermostats and things like that. And then you have Garrett Motion. They're spinning off too, which is turbochargers for, especially for like diesel things in Europe and stuff is their biggest market, I think. But that stuff's happening right now, right? So, and we had spinoffs in the past. We talked about Hamilton Beach Brands, right? We talked about NACCO because that was a spinoff from Hamilton. Hamilton Beach Brands was a spinoff from NACCO. So these are the sorts of things that are happening even right now. And then there's the question of like, are those cheap? The things I just mentioned. Honeywell's not really a cheap stock, right?
Sure.
ServiceMaster, what's the EV to EBITDA multiple on that? It's not real low, right? So, you have these things where it's a question of are they as attractive as they were when he was looking at them in those case studies?
Sure. Yeah, I'm not sure. I mean, we think so, obviously, because we manage it, yeah. And it's interesting because he also wrote about in the book, too, how most spinoffs don't tend to outperform to the first year. Do you recall him saying that?
So, yeah, and this is interesting.
So you could look at all of last year's ideas and kind of sift through them as well, yeah. Yeah,
absolutely. You can look at things that have been around for a little while. Some go off right away and don't come back down after that. Like I mentioned a couple times, BWX Technologies, that one was almost like but I thought you had to buy it before the spinoff because people would bid it up in anticipation. That did not happen at all. But then when the spinoff happened, it really went up. A different case is NACCO when it was the combined company. Within a year, when it had announced that it was going to do this and the spinoff was planned, the stock went up a lot. Then when the spinoff happened, the stock is basically at the same price today, I think, about the same price today as where it spun off. Almost exactly the same price you could get NACCO at today. So that one you would have made the most money if you bought it ahead of the spinoff and sold it, within a month or so after the spinoff, something like that, a couple months at most. So the timing is always very different. I think.
Do you think that comes from just the fact that more people know about spinoffs now?
Yeah, I think some people want to buy every spinoff. Their inclination is, I should buy this spinoff, even without knowing a lot about the business or something, and especially for a quick buck. So many people do basically where they just look at where the peers are, which is sort of what he suggests, and then if it's cheaper than the peers, you buy it.
Yeah.
Right. And they just want to buy every spinoff and see what happens. And as an index or something, that wouldn't be bad. I don't think you could do a lot worse than having a basket of all spinoffs. Yeah, but there is a timing thing. It's a question like we were talking about KLXE and what'll happen with that. The spinoff just happened, so maybe it'll trade down for a week or a month or something. I don't know. People have to get their shares and sell them if there's going to be selling pressure on it. So it depends on the situation. You attract different kinds of stockholders, right? So I think that this attracts people when there is activity like this, like there was with NACO. It attracts people who are more value investors, who are more short-term oriented, and are in it more for the catalyst. Because the same thing with the Boeing thing. Once it was announced that Boeing was buying KLXI, the people who are in it because they like the stock, all of those long-term shareholders and people who are in it for the quality, they get out, and there are basically people doing arbitrage there, ends up being the stockholder base, so it turns over completely. And I think you see that all the time with these sorts of things.
Great, interesting, and I think that's a pretty good place to stop. Do you think if you think anyone could take stuff away from Joel Greenblatt to add to their own investor toolkit, what would you say it would be?
I would say read the book. You can be a stock market genius. Just because in terms of what the research that he talks about of the process of what you do, how you find an idea. I think that's one of the best parts. There are other books that are as practical in terms of the actual stock ideas, but this is really the most practical book that I know of in terms of saying, okay, you read something that might be interesting. How do you follow up with it? What do you look into? And he describes sort of in the case studies almost what would have attracted your attention originally into it and things like that, which is often not what they do in other books. It's like, I bought this, but how did you know? How did you get attracted to it in the first place? Why were you interested in it? How did you follow up and learn these other facts and things like that? And he really goes into that, which is such an important part of investing. And the other possibility is you can look at the little book that beats the market. A lot of people like it. I'm not the biggest fan of that approach.
It's a pretty simple book to read.
It's a very simple book to read, and there's tons of screens and communities that talk about it and blogs devoted to it and all of that.
Do you know how the performance is done, like in real terms?
I know that.
I guess like
it was
real life.
Yeah, I know that for a while it was originally poor. After that, I don't know if that's continued. But it's not in that many different market environments. I think that that's basically testing a market, with FANG type stocks and things like that.
Yeah, sure. No, that's great. Well, we want to thank everybody for tuning in with us here today. If you do want to support Mr. Geoff and myself, obviously, this is a free podcast. You can do that by going to give us a rating and a review on iTunes, and that will make...
Or Apple Podcast, or whatever it's called.
Yeah, they'll make... Podcast. They'll make Geoff and I very happy. Other than that, we hope everybody has a great Wednesday. We will see you in the next podcast. We have a lot of people lined up to come on the show that we're very excited about. We're excited to bring them on, and a lot of people are really going to enjoy the conversations we are going to have. So we will see you in the next podcast. Everyone have a great week. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.